Okay, let's look at kit questions on variance analysis. Before we look at kit questions, you need to understand two operating statements prepared by marginal costing system and absorption costing system. So it is like variance report. You don't have to memorize this report. Just remember the top bit and the bottom. If operating statement or variance report is prepared using absorption costing system, we look at the budgeted profit from which we minus or add the sales variance, then it will give us standard profit for actual sales, which means that the sales that we have made other than the cost variances, this should be the standard profit. And then after that, we minus every variance that there is. So you don't have to memorize them. So just remember that at the top, we only minus the volume variance, and then once we have found the standard profit from actual sales, then we minus everything else, which will give us the actual profit. Now we do the same thing with marginal costing, but in marginal costing, instead of having budgeted profit, we have budgeted contribution. Instead of having sales volume profit variance, we have sales volume contribution variance, because sales volume variance according to absorption costing and marginal costing is different. It will give us standard contribution from actual sales. Now in absorption costing, we minused all variances, but in marginal costing, we minus the variable variances. Then it will give us contribution. Remember, in absorption costing, we take sales, we minus all the costs, it gives us profit. In marginal costing, we take sales, we minus variable cost, it gives us contribution. Then we minus fixed cost, then it gives us profit. So in the same way, when variance report is prepared, first we minus the variable variances, which will give us actual contribution. Then we take the budgeted fixed cost and we minus expenditure variance, which will give us actual fixed cost. And then we have actual profit. Remember, from budgeted fixed cost, we only minus expenditure variance. Volume variance is not mentioned here. So absorption costing is straightforward. Only remember this part, and then you have to minus everything else, which will directly give you profit. So the questions in exam will be, they will ask you to find actual profit, and then they will give you variances. So you need to know that whether that variance comes before or not. For example, if they tell you to calculate standard profit from actual sales, and then they give you all of these variances, then you should know that they are not minused from standard profit from actual sales. Only volume profit variances would be deducted. Just like that, when they ask you actual contribution, you would know that fixed variance would not be deducted from it yet. So you need to remember this much. Now let's look at kit questions. Now kit questions are many. There are many questions there. So I will try to answer as many as possible. Obviously, I will not be able to answer all of them. Okay, let's start with variances. What are material price and usage variance? Remember, I have seen in many places where they have formulas for variances, and they are very difficult to memorize those. So if you understand it conceptually, in my videos explaining the variances as well, I didn't explain formula, I explained the meaning of that variance. So once you understand variances meaning, you will see I never use formula to answer these questions. Okay, so what are they asking? What are the material price and usage variance for July? A company manufactures a single product L for which standard material cost is as follows. We have material $3 per kg, and during July 8,000 units of L were manufactured. 12,000 kgs of material were purchased for 33,600, of which 11,500 kgs were issued to production. SMCO values all inventory at standard cost. Okay, so when we are calculating price variance, we look at the kgs purchased. No matter how many kgs we used, it doesn't matter. We look at purchase. So we have 12 kgs. We should have bought them at standard price, which is $3. That would give us 36,000, but we bought them at 33,600. It means we bought them cheaper. So cheaper would mean it is favorable. How much is it? If we minus 33,000 from the top, it becomes about 2,400. Favorable variance. Now let's look at usage variance. We produced 800 units, and even though we purchased 12,000 kgs, we used 11,500. So when we talk about usage, we take the kgs used. So 800 units should have taken 14 kgs each, which should give us 11,200, and we used 11,500, which gives us 300 adverse variance. But obviously we need to convert it to cost, which is at $3, gives us 900 adverse. So you can see I don't use formula, you just have to understand it conceptually. So we have 2,400 favorable and 900 adverse, which means C is correct. Okay, next one. What is the direct labor rate variance and what is the labor efficiency variance? A company expected to produce 200 units of product, the bone, in 2013. In fact, 260 units were produced. The standard labor cost per unit was 70, which is 10 at the rate of 7 per hour. Actual labor cost was 18,600 and labor force worked 2,200 hours, although they were paid for 2,300 hours. Okay, first, rate. When we talk about rate, we take the hours paid. Just like in kgs, in material, when we are calculating price, we take the kgs purchased. Here we take the hours paid, even though the hours worked is less. So for the hours that we paid, we want to know whether we paid higher rate or lower. So we have 2,300 hours. We should have paid a standard rate of 7 per hour. That means we should have paid 16,100, but we paid 18,600. For the hours that we paid 18,600, which means we paid higher, which becomes about 2,500. So 2,500 adverse. And then efficiency, we take hours used. So we produced 260 units. They should have taken 10 hours each, which means 2,600 hours, but they have taken 2,200 hours, even though we paid for 2,300 hours, but the hours used is 2,600, so we take hours used, not hours paid. So we have 400 favorable, we have used 400 less than we should have. So multiply that by the standard rate, which is 7, we have 2,800 favorable variance. Even though we paid a higher rate, but we actually saved on efficiency. So overall, you can see we have saved $300 on labor. Next, variable production overhead, expenditure and efficiency. Expenditure and efficiency is just like labor rate and efficiency. It is calculated exactly the same. Extracts from company's record for last period are as follows. We have budget, production, variable overheads, and then labor hours worked, and then actual units, variable overheads, and labor hours worked. So in expenditure, we looked at the hours that we paid, the hours worked. For each hour worked, how much should be our overheads? So in standard, we have 11,550 divided by 5,775, so we have 2 per hour. If we have 80 hours worked, we should have 2, which gives us 16,560 overheads, but we have 14,904, so we have favorable variance. When we calculate that, let me do it here. 16,560 minus 14,904, we have 1656 favorable variance because we have incurred less. And then we have efficiency. Efficiency is done exactly the same way. The time that should have been taken, according to the standard, we have total time allowed, and then we have total units. That means we have 3 hours per unit. If we produce 2070 units, each unit should take 3 hours, which means 6210. But it actually took 8280, it took more hours, so we have adverse variance. 8280 minus 6210 becomes 270 adverse. When we take that, multiply by the standard rate, which is 2, becomes 1440 adverse. So our answer is 1656 favorable and 4140 adverse, which means C. Next, what are the fixed overhead variance for the period? Expenditure and volume. Remember, expenditure looks at overall money that we have spent, and volume looks at the budgeted in actual units. So a company has budgeted to make and sell 4,200 units of product X during the period. We have standard fixed overhead cost per unit of 4. During period covered by the budget, actual results were as follows: production and sales, fixed overheads incurred. What are the fixed overhead variance for the period? So in expenditure, we're looking at the total budget and actual. Total budget is not given, per unit is given, but if we take overhead per unit, multiply by budgeted units, it should give us total budgeted overheads. Total budgeted overheads is 16,800 and actual is 15,700, so we have 17,500, so we have 700 adverse. We have more total overheads. And in volume, we look at total units. We have more units produced. More units is good because the more the units, the less the cost per unit. If you don't understand this concept, go back to the cost behavior topic I explained. The more the activity, the less the cost per unit is. So when an organization has more activity, the cost per unit for fixed costs will reduce. Now it is another topic that whether those units can actually be sold or not, but from the perspective of production, more production would mean less cost per unit. So we have 800 favorable, multiply by the rate per unit, which is 4, we have 3,200 favorable. So we have 700 and 3,200. 700 is adverse. So we have about 2,500 favorable variance. The answer is C here. Next, what are the fixed overhead capacity and efficiency, which are the sub-part of volume variance? Remember, in accounting for labor chapter, we had 3 ratios for labor. One was production volume, efficiency, and capacity. Efficiency was the speed at which employees were working. Capacity was how long employee was working. And both of them multiplied gave you overall volume that was achieved. A company manufactures a single product, and relevant data for December is as follows. We have production units 1,800 and 1,900, labor hours 9,000 and 9,400, and then fixed overheads. Okay, capacity. Capacity looks at total time available and total time work. In capacity, the more hour we work, the better it is. If you forgot about it, go back to that accounting for labor chapter and look at the ratios. So if we have more hours, it is better. Budgeted hours is 9,000, actual is 9,400, so it should be 400 favorable. 400 favorable multiplied by rate per hour. We have fixed overhead of 36,000, dividing that by the time, which is 4 per hour, multiplying by 4 per hour gives us 1,600 favorable variance. Next we have capacity. The capacity is the time that we should have taken and the time that we have actually taken. So 9,000 hours for 1,800 units would mean 5 per unit. So if 1,900 units are produced, 5 would mean 9,500 units. We should have taken more time, but we have actually taken less time. In capacity, more time is good. In efficiency, less time is good. Capacity is time worked. Efficiency is time taken. The more time you work, the less time you take, the more will be your production. The less time you work, the more time you take, the less will be your production. Okay, so capacity, if your capacity is higher and your efficiency is higher, your volume will be higher. If efficiency and capacity is both is lower, then your volume will be lower. Go back to that accounting for labor chapter and look at ratios there if you forgot. So 100 favorable multiplied by 4, we have 400 favorable because we have taken less time. Which of the following would help to explain favorable direct labor efficiency variance? So what it simply means is, why would there be a efficiency variance which is favorable? Employee were of lower skill level than specified in standard, better quality material, easier to process, suggestion for improved working methods were implemented during the period. Any of these things that would mean that employee would work faster would be right. If employees are lower skilled, they will work slower, so this cannot be the answer. So if one is not the answer, we can eliminate A and B and C. That automatically means B would be correct. This is called an elimination method. Sometimes, even though if you don't know all the answers, you can remove the answer that you know are not correct, then you will be able to answer. Let's look at B. Better quality material was easier to process. The quality of material has effect on time taken by labor as well, because higher quality material will be easier to process, lower quality material will be difficult to process. So this is true. Suggestion for improved working methods were implemented during the period. Yeah, if we have new methods applied, that means work would be done faster. So that means C is correct. Which of the following statements is correct? I don't think it is a very important question. I will skip it. This isn't any difficult question either, so I will only focus on the ones that are new and difficult. What was the fixed production overhead capacity variance? Okay, let's see. A manufacturing company operates a standard absorption costing system. Last month, 25,000 production hours were budgeted, and budgeted fixed production overheads cost was 125,000. Last month, the actual hours worked were 24,000, and the standard hours for actual production were 27,000. Standard hours for actual production means that the time we should have taken for the units that we have produced. This 25,000 units should have taken 27,000, but we took 24,000. So we took less time. In terms of efficiency, it is favorable. But in terms of capacity, it is adverse, because less hours means less work. So it should be adverse. Sorry, this is not units, these are hours. 25,000 hours were budgeted, and we actually worked 24,000 hours, so we have adverse. Efficiency would be favorable, but capacity would be adverse. So if we have 125,000 divided by 25,000 budget, it will give us a rate. And then take that 25,000 minus 24,000, we have adverse 1,000 multiplied by the rate, we have 5,000 adverse. If they ask about efficiency, then we would compare efficiency 27,000 with 24,000, we would have 3,000 favorable. 3,000 favorable multiplied by 5, we would have 15,000 favorable variance for efficiency if they asked. But remember, they are different. Okay, then we have other variance. They are per unit. Per unit is simple. You just take the total cost divided by per unit, multiply by actual. So it isn't anything difficult about it, so I'll leave it. Also straightforward. What is the total fixed overhead variance? The graph below shows standard fixed overhead cost per unit, the total budgeted fixed overhead cost, and the actual fixed overhead cost for a month of December. The actual number of units produced in June was 2,500. So what was the fixed overhead variance? They didn't ask whether according to marginal costing or whether according to absorption costing. So usually when they ask about overheads, they would tell you according to which method, or they have to specify whether it is efficiency or expenditure. Remember, we don't have volume variance in marginal costing system. Okay, so let's calculate it according to absorption costing, because that is what I believe it should be. Otherwise, according to marginal costing, it is very straightforward. Okay, so we have to find data from the graph. So at the top, we have actual number of units produced, 2,500. We have budgeted fixed overheads, we have actual fixed overheads, and then we have some ratios here. Okay, so we have two things. We have expenditure variance and volume variance. Both of them combined will give you total variance. Actual overheads is 12,500. When we compare that with budgeted total, it will give us expenditure. This is 12,500, but we don't know this one. You can see it is in the middle of 17,500 and 5,000, 15,000. If I take that minus, gives us 2,500. If I take 2,500, becomes 1,250. If I take 15,000 plus 1,250, that gives me 16,250. So what I've done is found the difference between these 2 points and then divided by 2, added that to the 15 to give us that figure. Now we can take 16,250 minus 15,000 minus 1,250. The budgeted and actual. We have 3,750 expenditure favorable. Now, according to marginal costing, this is the only fixed overhead variance. But let's calculate volume variance. Actual units are given, budgeted units are not given. But there is something given as a standard fixed overheads. So we have a line here which says 10,000 cost, and we have in the middle 2,500 units. So standard for 10,000 units, we have for 2,500 units we have 10,000 fixed costs. That means 4 per unit. Now this is not budgeted units. This is budgeted fixed cost per unit. Now if you take the budgeted fixed cost that is given, which we calculated as 16,250 and divide by this 4, it would mean that 4,062.5 was budgeted units. Because budgeted overheads divided by budgeted units will give you OIR. Budgeted overheads divided by OIR will give you budgeted units. So units budgeted were more, actual is less, so volume would be adverse. We have 15, 62.5 adverse, multiply by the overhead absorption rate, which is 4, will give us 6250 adverse volume variance. Even though we have 2750 favorable, we have 6250 adverse, we have 2500 adverse variance overall. Okay, let's continue. PQ is considering using standard marginal costing as a base of variance reporting in the future. What variance for fixed overhead would be shown in marginal costing operating statement for November? A company currently uses a standard absorption costing system. The fixed overhead variance extracted from operating statement for November, where fixed overhead expenditure variance, capacity variance, efficiency variance. Remember, marginal costing, fixed overhead is only expenditure variance. Capacity and efficiency are sub-part of volume. Volume variance don't exist. So the variance that would be reported would be 5,800 according to marginal costing, which would be C here, B. Which of the following situation is most likely to result in favorable selling price variance? Favorable selling price variance means we were able to sell at a higher price. Remember, you don't only have to know what a variance is. You also need to know why variance happens. In F2 level, you don't have to know as much, but when you go to F5 level, P4 level, P5 level, you need to know that in depth. Okay, so the sales director decided to change from planned policy of market skimming pricing to one of market penetration. Market skimming means charging higher price. Market penetration means charging lower price. So if you change from skimming to penetration, price variance would be adverse, not favorable. Volume can be favorable because of the lower price. Maybe people buy more, but price variance would be adverse. Fewer customers than expected took advantage of early payment discount offered. Payment discount doesn't have anything to do with price. It is an administrative expense. Competitors charge lower prices than expected. Therefore, selling prices had to be reduced in order to compete effectively. Again, this would make price lower. Demand for the product were higher than expected, and prices could be raised without effect on sales volume. This could be the answer. Okay, this next question relates to 14.3 to 14.6. 3, 4, 5, 6, 4 questions. So the requirement is, what is actual production in February? What was actual usage of direct material during February? What was the selling price variance for February? What was the sales volume variance? Now, in variance analysis question, they would not always ask you to find variance. They could give you variance, they would ask you to find actual, or they could ask you to find budget. So two things will be given, you have to find the third one. Okay, a company manufactures a single product and extract from a variance control report together with relevant standard costing data is shown below. We have standard selling price per unit. We have standard direct material cost, budgeted total material cost of sales, budgeted profit, then actual result for February, sales revenue, direct material cost, direct material price variance, direct material usage variance. So what was actual production in February? Now, variances are given. From variances, we have to find the budget and actual data. Okay, so we have direct material, total actual. We have 2,400. If we look at the price variance, it is 800 adverse, which means that this material that we bought for 2,400, we could have bought it for 800 less. That means 1600. So whatever we paid for the material, which is 2400, what it actually cost. But if we had purchased them at standard price, we would have purchased them at 1600. So if our 1600 is the standard price, that means dividing by 2, that means we have 800 kgs. This is the price for 800 kgs, standard price. Okay, so I've taken the actual price that we paid for material. If we had paid according to the standard price, we should have paid 1600. So this 1600 material divided by 2 becomes 800 kg. In the first one they asked what is the actual usage of kgs. So usage of kgs is 800 kgs, because whatever is material here, 2400, according to standard price, if we had purchased it, we would have purchased it for 1600, dividing by the price per kg, that would give us 800 kgs. They ask about here what is actual production. Now they said usage is 400 favorable. It means that if I take 400 divided by 2, we have 200 kgs less used. Even though I've used 800 kgs, if I had used them at standard usage, I would have used 1000 kg. So 1000 kg would be for how many units? For 200 units. So from one data we found another data. So difficulty in questions like these is to find where you should start from. So I found the kgs standard, and then I added the more or less kgs to find the total kgs, and from that I found units. So the answer for this one is 200 units, and this one is 800 kgs. What was the sales price variance for February? We have sales revenue of 15,200, but they didn't tell us how many units did we sell. Because 200 units were produced, we would assume that 200 were sold, because they said there was no inventory. Standard price per unit is 70, so 200 multiply by 200, 70 standard price multiply by 200 units that we sold. We should have sold it for 14,000, but we sold it for 15,200. That means we have sold it expensive. We have 1200 favorable variance, and then we have a volume variance, which is this budgeted units. Budgeted units total is not given, but budgeted profit and material cost is given. Budgeted profit is given here, but we need to find profit per unit. For that, we have to divide by total number of units, but units are not given. Total material cost is given here. If I take the total material cost and divide it by the cost of material per unit, which is 10, that gives me 230 budgeted units. 230 were budgeted units, and we sold 200 units, multiplying by the profit per unit. Profit per unit is not given. Now I can take the total profit, divide by that budgeted units. It will give me profit per unit. So multiply by 30. Remember, this will give me difference of units, multiply by the profit, because we are using absorption costing, and they said sales volume profit variance, so we have to multiply by profit. We have 900 adverse. Overall sales variance is 1200 favorable, 900 adverse, 300 favorable. Next, what was actual number of units produced? company uses standard absorption costing. The following details have been extracted from its budget. For April, we have production overheads, and then this is budget. In April, fixed production overheads was under absorbed by 8,000. It means we have absorbed less than the actual. And the fixed production overhead expenditure variance was 2,000. What was the actual number of units produced? Okay, remember, under or absorbed is the total variance, and then expenditure is just the sub part. So if budgeted is 48,000, and we have 2,000 adverse, that would mean our actual overheads is 50,000, because the difference between budgeted and actual is your actual overheads. If this is actual overheads and we have 8,000 under absorbed, remember we write actual, we minus absorb from it, it gives us under or absorb. In this case it is under absorbed 8,000. So if actual is 50,000 and under absorbed is, from this we can find it is 42,000. We can find for how many units we have 42,000. If I take 42,000 divided by the standard rate, which is 48,000, budgeted overheads divided by budgeted activity, we have 10. So dividing by 10, we have 4,200 units actually produced. A company purchased 65,850 kgs of material at a price of 21.90. The material price variance was 13.70 favorable. What was the standard price? Price per kg. Okay, 21,920 is the actual cost. If we had bought it at standard price, we would have bought it expensive. It means we would have bought it 23,290. So dividing that by the kgs that we purchase, so the standard price would be 3.40. Next, profit reconciliation are done up using marginal costing principle. What sales variance would be included in such a statement for the period? We have sales. The following data relates to one of the company's products. Sales price, variable cost, fixed cost, profit. Budgeted sales for control period 7 were 2,400, but actual sales were 2,550 units. The revenue earned from these sales were 6,730. What sales variances would be there? So price and volume. First, let's look at price. 2,550 units that we actually sold, we should have sold it at 27. What you can do is you take 27. Okay, the other is total is given. So if per unit was given, then it would be easier to do it like this. So we have 27, which will give us 68,850, and we actually sold it for 67,320. So we have adverse variance, which is 68,850 minus 67,320, 1530 adverse. Next, volume variance. Budgeted units were 2,400, but we sold more. So more sold is favorable. Just take 2,550 minus 24,000 budgets we have favorable, multiply by, because we're using marginal, we will multiply by contribution. Contribution is profit plus fixed cost, which is 6 plus 9, or 27 minus variable cost, which gives you exact same thing. So multiply by 15. If we were using absorption costing, we would have multiplied by profit, but because we are using marginal costing, we will multiply by contribution. So the answer is adverse 1530 and favorable 2250, which is B. Okay, I will leave this one. This is also simple. This also seems simple. Okay, a company uses standard marginal costing. Last month, the standard contribution on actual sales. Remember, standard contribution on actual sales, we take budgeted contribution, we minus sales volume variance, that gives us standard contribution on actual sales. So volume variance is already deducted from this. And the following variances arose: variable, sales price, sales volume contribution. See, this is already deducted. So they're asking actual contribution. So we take 10,000 minus 2,000 plus 500. So the only variance that is deducted from this one is sales volume, and we will not deduct it again because it is already deducted. So if you forgot it, go back to that chart. Remember, you only have to remember the top part of the chart and the bottom. You don't have to memorize the whole thing. ADCO is considering using standard marginal costing as a basis for variance reporting in the future. What would be the correct sales volume variance to be shown in marginal costing operating statements? I think it is simple. I'll leave it. This, I believe, relates to absorption and marginal costing. Okay, leave this one as well. Okay, budgeted contribution for HMFCO was 290,000. Budgeted contribution is at the top. No variance has been deducted yet. The following variances occurred, and what are they asking? Actual contribution. It means we have to minus all variances other than fixed overhead variance. So no variance has been deducted from this yet. Fixed overhead variance, no, we don't minus that. Labor variance, yes, we add that. Total variable overhead variance, yes, we minus that. All variable will be minused. Sales variance, yes, we add that. Fixed overhead volume, no. Volume doesn't exist in contribution, marginal costing. Expenditure exists, but we do that after actual contribution. Go back to the operating statement if you forgot. Sales volume variance, yes, we minus that because it is budgeted contribution, not standard contribution on actual sales. Then material variance, we minus that as well. So we have 290,000, then 11,203 added, 21,665 minus 21,875 added. Volume doesn't come here. Sales volume does come, 3650, so we have minus that, and material as well. So we have 258,948 actual contribution. So this is it for variances. So every important thing I believe I've answered in these questions.